All right. Welcome to Reflexivity of Markets, where we analyze market dynamics in relation to narrative and value. I'm Steven. This is Jordan. Today we're going to talk a bit about USDC's DPEG this past weekend, what that means for markets, and what we can do going forward, and what people are deciding to do as a result. I'm just going to pull up the USDC chart here, so we have a quick uh, vision of what we saw this past week. Uh, you know, about on Friday. Jordan will talk a bit more about it, but we saw changes happening in the financial system, specifically with some regional banks. As a result, we saw a huge DPEG in USDC, all the way down to, in some exchanges, down to the low 80s. And in this coming days, the peg did come back, but needless to say, we did see a lot of fear, uncertainty. We saw people that saw it as an opportunity for um, to capture that growth. And we're just going to talk a bit about that today. So, yeah, Jordan, you just kind of break down what happened last week and how it led to what we saw in that USDC DPEG.
Good. So we're not going to ask me to start 2,000 years ago, the creation of modern money. Okay. Uh, instead, we're going to focus on a setup that was a interest rate long duration exposure for Silicon Valley Bank, speculating that they could own fairly illiquid long duration assets in treasuries and to continue banking practices with tech firms that were not profitable and had significant risks in their main business practices. And in the course of doing business, they accumulated a liquid number of assets to the tune of north of $200 billion to back the deposits held at their bank, which, like all banking deposits, are available on demand. There was a moment last week when they acknowledged they had to write down several large assets and liquidate them in order to provide depositors access to their money. And that sparked an ensuing bank run that would probably be best called a social media viral bank run, as people started posting about this very quickly. And everybody who's a Silicon Valley Bank client is very big in tech and is active in social media and Twitter. And so the withdrawals cascaded quite quickly. Um, as SVB uh, disclosed they were going to have to close and have FDIC take over on Friday morning. That's the Federal Deposit Insurance Corporation. Uh, the question became who were their banking partners and how did it affect crypto? And one of the known partners was Circle. Circle kept deposits at six banks, according to their statements. Uh, One of those was Silicon Valley Bank. And at the time, people speculated it's 1/6 of their outstanding cash reserves. It's or it's less or it's more, and there's a big question of uncertainty around that. Given the backing of Circle is an immediate one-for-one redemption mechanism, any shortfall in cash availability would be significant to redemptions. So we saw a an instantaneous DPEG. And then as they released more information, we found out the scale of their exposure at Silicon Valley Bank was 3.3 billion. And as Stephen said, we eventually saw markets freak out and collapse to 88 cents on the dollar at one point. Um,
Yeah, I'm just going to pull up Circle's updates that they had on March 13th. I don't know if you guys can see it there. Let's see if we can get this a little bit bigger for you guys. Uh, yeah, but essentially it talks about their USDC being 24/7, 365, which those in crypto come to love, and why stablecoins have such high value within the crypto space. However, they did talk about their in relation to the bank, the banks on Monday. They'll have to wait for those to open before they can start redeeming um, those withdrawals. And as we look down here, we see 23% or 9.7 billion held in cash of their treasury, and uh, of that, we did see 3.3 billion in with SVB. So that was just on March 13th. They had this immediate release. Um, and it just kind of started a bit of the resolution for what was happening, because up until this point we did see a lot of uncertainty. How much is with each of the banks, and what does that mean for USDC holders going into the rest of the weekend? Our traditional markets were closed, but crypto never sleeps. So it was exciting to say the least for those that were following what was going on.
So I'm gonna share some more detail and color on kind of as this unfolded, what it looked like. Clarify some of the earlier statements. So uh, you can see the disclosure from Silicon Valley that from Circle that Silicon Valley Bank held a portion of their reserves. This is from Friday. On the same day, we saw this is the reflection of their current, as of March 9th, reserves. So they were holding $43 billion in backing for their stablecoin, composed significantly of about 11.1 billion in cash. Uh, as we found out through later on in that day, they would disclose that that was 3.3 billion, as Stephen showed you. Um, and for a while, the arbitrage windows were open for redemption. And what that meant was large players were in the market, like Jump, and then smaller players who were willing to go leverage quite quickly, taking opportunities to buy Circle or USDC, a coin in the open market with almost any asset that was stable, USDT primarily, to deposit it on Coinbase or on Robinhood. And then after that, to convert it one to one, and having bought it for, let's say, 93 cents and converted it one to one, capture an instant 7% or 7 cents on the dollar gain. And then they would go through that fiat back onto Coinbase, purchase USDT or DAI or whatever was holding PEG at the moment. Eventually, DAI did not hold PEG. Go back on the open market on chain and swap it out for USDC, deposit, redeem, and repeat. This was a huge arbitrage opportunity for anybody willing to seize it. And we're going to pull up.
Which link did you want pulled up? There, I can see if I can try and
There we
track
go.
it.
So, as Peck Shield showed, there was a redemption on Circle of about 2.7 billion in the 24 hours leading up to about 4 or 5 p.m. on Friday. Coinbase had 1.78 billion, and Jump Trading had $96 million redeeming. The consequences of this were a ton of money printing, in the sense that people were printing profits on and riskless arbitrage until we had a significant moment when Coinbase decided to freeze all redemptions, which was followed by Robinhood freezing redemptions. When they froze redemptions, uncertainty unfolded because, like during most crypto crises, we heard a large number of players saying, "Don't worry, guys, everything's fine. We'll get back to business on Monday." Um, and while this time it did actually happen, for those who've been in crypto for a while, there have been a number of times where things did not get back to normal. And the large institution saying, "Don't worry, this moment is fine," is the last moment before everything collapsed. So we just want to take a moment, and before we discuss how this was all brought back to PEG, also acknowledge that there were a lot of DeFi exploits around this where decentralized protocols inherently valued Circle as $1, even if its price feed or its live market value was not. And so borrowing against it could be treated differently. Um, and and when the kind of what we'll call the primitives of finance in this, the definition of what $1 is are broken down. A lot of dependent interfaces and products do not function as they're supposed to, and the risk management for them falls apart. So there's a lot of on-chain arbitrage in addition to the redemption arbitrage that occurred in this, including a play by Gabriel Haynes. We'll leave out of the discussion for a moment, but significant to say, Sifu did $100,000 arbitrage in a very narrow window. Um, it was such a significant level of on-chain activity that going to go ahead and
Which link
bring.
is it there?
In the future, we're going to be sharing the full window. Aave had to freeze stablecoin trading on Avalanche V3, and several other protocols had to deploy emergency actions to cap USDC interactions. Um, so, just going to take a moment to say why people were effectively misunderstanding the risk on the table. Um, when Am I lagging for you, Stephen?
Yeah. A little bit, but you're good. Go ahead.
Uh, when we look at the history of assets that are backed by a not large number of reserves, and people are speculating on the value, I'm lagging significantly. Let me fix this.
Okay,
Gonna,
that's okay. It's okay. While Jordan's going through that, uh, as someone that's been in crypto since 2017, it was interesting to see just how people reacted, especially on Twitter and Discord discussions. What people were talking about as opportunities. Um, with stablecoins being such a dominant, having such a dominant role within DeFi, uh, it was almost impossible to miss. So during that, especially during the weekend time, most people were trying to figure out what the best strategy was for themselves. Right, everyone has their own risk reward and risk tolerance that they can take on, and we definitely saw that just through the price fluctuations within USDC itself and the rest of the market. And we'll see in a second here. We'll talk about on what happened on Monday um, and what the Fed decided to do to help the situation and how the market decided to play that. I'll bring
so
Jordan back up here.
I think we're now back to not lagging. So we'll just take a moment to explain in a traditional bank run or an asset run, an asset crash and flash liquidation scenario. People who are valuing a bank or the holding entity would value it on some discount overall to the assets in the current mark to market. Let's say they were losing or missing $3.3 billion of $43 billion total. You just subtract that as a percentage, and that's the discount. So people were pegging Circle to be worth somewhere around 93 or 92 cents on the dollar. Um, but that's actually not the situation that would have unfolded if redemptions had opened on Monday and they had not had access to $3.3 billion. Uniquely, this is a digital one-to-one redemption mechanism, and that means just like a depositor at a bank, you can claim $1 back from them at any time until there are no dollars left. You don't get 93 cents on the dollar because that's what they have currently. You get one to one, and then we find out which $3.3 billion of USDC were outstanding hypothetically, and what time frame people if would have access to what percentage of that if SVB had gone through a traditional liquidation process of selling its assets and repaying its depositors. So that was a different situation that I think people were not properly understanding, and that's why saying it's quite simply a discount on the amount at SVB or a discount minus a percentage of expected repayment from SVB was probably inaccurate and led to potential risks for kind of the last person in the game of musical chairs with a bag left holding. So when we go to Sunday, as panic was pretty widespread and rescue plans were unclear for Silicon Valley Bank, Stephen just had that pulled up. We had the Federal Reserve announcement was
Go ahead.
oh, there we go. So the Federal Reserve announced in conjunction with the FDIC and Treasury that they were stepping in to guarantee all depositors received access, not just insured depositors. So people with more than $250,000 in an account, institutional depositors such as Coinbase and Circle, um, were going to have full access, and they were going to backstop this by allowing special access for both Signature Bank, which was one of Coinbase's key banking partners, and for Silicon Valley Bank to emergency lines of reserves and credit from the Federal Reserve banking system, and to be made whole uh, for all depositors by a special, essentially, tax or assessment on other members of the banking system. That was how they kind of negotiated the no taxpayer cost concept. And as a member of the FDIC, you are legally required to participate in this special assessment to compensate those depositors. Once they announced this, it was also announced by Coinbase or by Circle that they had the entirety of the rest of their deposits at Bank of New York Mellon, which is a systemically important institution. An SIB is a systemically important bank, or a CFI, which is a systemically important financial institution, which have special requirements and special access to emergency funding for making sure depositors are made whole. At the same time, Circle announced they would be fulfilling full redemption access. SVB announced because of this they'd be able to facilitate all withdrawals. Signature did as well. And at that moment, it became clear USDC should return to a $1 peg.
I think that
And
was right around Sunday evening, correct?
yeah, Sunday, 6:15 Eastern time.
Yeah.
Um, and people went, as I'm quoted in Business Insider now, saying hyper long, or if we're talking in crypto terms, gigalong with 50x plays on USDC versus USDT and perpetuals trades that might have seemed degen even a moment earlier, but in that particular moment were effectively bets that the U.S. government was going to keep its word. And yeah, that brings us pretty much to the moment when all of this was resolved, as Circle decided in the announcement shared earlier to say that the peg risk is removed, the reserve risk is gone, um, and that kind of brought us to the end and where we are right now.
Yeah, it's one crazy to think, like crazy 72 hours or however long it was. Uh, I just wanted to bring up the treasury chart here, specifically the 1 year, um, just so we can take a look here. And if you look back at history, we're on the floor right now. Let's go back to the weekly. Right, substantial change in rates for treasuries. Can you just talk a bit about the significance of this move the past few days, in relation to a shift potentially in market sentiment, and how people should be allocating or deciding or figuring out what's in their best interest as a result of what we just saw the past week. Yeah,
Yeah, given the framing of that question, I'm just going to reiterate this is not financial advice. We
absolutely
provide
not.
this as an educational content and entertainment content, and that this is all for increasing everybody's understanding, but everybody's financial decisions are their own and you should be consulting your own financial advisor for advice. So, Stephen, would you mind also pulling up, just clicking between that and then also grabbing the 10-year, just so we can take a look at the move on the 10-year, which was
Yeah,
also a giant wick. So, huge volatility um, in treasury markets. Effectively, what we were looking at, and then do you have the 310, the 1-3 spread or no
no,
on
I just
that?
have the 30. Yeah, the 30, and I have the 1 and the 10.
So I'm gonna go ahead and grab mine so that we can have that in a second. Just pulling up. Uh, Alrighty then. And just give us one moment there. Okay. So if we're looking at what happened, basically there's a significant pricing of the yield curve, which is the yield over given terms of treasuries. So 1 year yields versus 3 year yields versus 10 year yields. And when people talk about inversion, which is a very common term in the space, and everybody wants to mention it even when they don't seem to understand it sometimes these days, which may or may not frustrate me. What we're talking about is people saying that the 10 year is lower than the 1 year, or that the 3 year is lower than the 1 year as well, and how steep that changes. So heading into Friday, Jerome Powell earlier in the week had said, we're going to go higher for longer. We're prepared to raise interest rates materially above the current levels and continue hikes further. That sent rates, if you grab, can you show up the 1 year over the
Yeah.
last? There was a massive 1 year spike during his testimony. And that's when we left trend line. I think that was Wednesday, and went up to that peak right before the crash. That was people suddenly realizing that rates were going to go higher, and therefore they wouldn't be willing to buy treasuries that didn't provide them an effective yield of 5.2%, I believe, at one point during that 5.25%.
Yeah.
Um, and then suddenly, with the collapse of a bank, people were looking for two things. One was a flight to quality, is what it's called. So treasuries are considered very safe. And so people drained their cash from anything into treasuries. There is no FDIC limit on your treasuries. There's just, if you have the right to the treasury and the US government decides to pay you out like they always have, it's a safe place to park cash. When you bid on treasuries and the price of treasuries rises, the yield falls. And that is one portion of how this collapse happened in rates. And the other portion is the expectation that the Federal Reserve would be able to continue to hike rates declined. So if the idea was the Federal Reserve will hike rates as long as they don't break the system, the narrative had switched to the system has been broken. And so they will have to stop rate hikes. And the interest rate curve started to show an expectation that instead of one or two more hikes this year, zero hikes this year, and in fact, one rate cut this year, possibly more. Um, and so the short end of the curve, which would be the 1 year term, and the 3 year really collapsed. The 10 year also took a huge move, but less than the others because it was not as elevated. The curve is still inverted, but it flattened out quite a bit there. And the spread between those changed significantly. Um, So this was kind of the volatility in the spread between the 1 year and the 3 year. We have the 1 year minus the 3 year, and going into this, we had a spread of about zero point 0.4. Then that spread widened out significantly, and we've had a significant amount of volatility in that space, much more than in fact looking at the individual pieces, right? So this is a let's see, from top to bottom, 22 to about 90, 70 basis points of swings in the spread between 1 and 3 year on the curve. Um, so yeah, it's just something to understand about this is the market expectations are being priced here in terms of rate hikes, and when that shift happened, the question was then, so are we now in a quantitative easing uh, era, or is that the paradigm we've shifted to? And is it the same thing to say quantitative easing as lower interest rates? And they're actually not quite the same. Monetary conditions may be tighter, while in fact the quantity of money can be changed by quantitative easing or quantitative tightening. But the rates will also affect how expensive that money is and how tight financial conditions are across the board. So it's kind of a moment of a lot of questions being asked. Should people be going long risk assets? And the conclusion was largely that Stablecoins in crypto were safe because they could be redeemed, so people jumped back in and felt pretty safe, and that rates would come down quickly. And therefore, we saw, as Stephen will mention, crypto sentiment in the majors of Ethereum and Bitcoin skyrocket. There was a big risk on shift. I mean, then when
There we
with
go.
rates let's say, no longer higher for longer, and in fact lower sooner, the open of all markets, that were available on Sunday night and eventually Monday morning, sent markets running up. Markets have since reversed course quite a bit in equities. There's still a lot of gray area there as to whether or not the Fed will continue to try to fight inflation, but there's a lot more expectation that we're done with rate hikes, it's not my personal opinion, just what the market's expecting.
Yeah, and just kind of going through that and seeing how it affects the crypto market specifically. Uh, Anytime there's an issue uh, with the banking system or um, traditional finance in general, and they see the people that there are still cracks in the system. The one thing that people always rely on is Bitcoin's immutability and its ability to create that safe haven of assets. So we did see a huge jump into things like Bitcoin and Ethereum from those announcements, and we'll keep tracking the follow through and how it goes, how it comes forward, with the rest of traditional finance and what's happening across markets. But yeah, it's interesting to see, right, it's approaching previous highs across the board in risk assets, and for what was a like a 20% move in Bitcoin in just a matter of days, uh, you can start to see people's sentiment shift to risk on, especially when it does come to a financial sector. And some would argue that Bitcoin is part of that financial sector, um, but um, it's now seen as that maybe that the time for Bitcoin as a hedge is starting to come about. So we'll keep monitoring that. Is there anything else that you wanted to discuss, Jordan?
So I just wanted to say, what we're the consequences of this, like Steven said, are going to continue to be felt. We're going to see regional banks that have concentrated exposure to a particular demographic, to a particular region, um, and have what we're calling idiosyncratic risks, uh, face pressure to either be shored up from regulatory requirements against these kinds of risks, or to consolidate to larger banks. And you are hearing the narrative right now about how many of these should be absorbed by companies like JP Morgan or other SIBs in the space. And there are some limitations on how much of the U.S. total deposit base can be held at one bank. But there's a significant push for consolidation in the moment. There's also kind of questions about how this will affect startups in the space, how this is going to affect the ability to finance startups in Web3 and in Web2, and what this will mean. For the moment, it means Circle has faced the greatest test of its USDC product ever, uh, and that it came out in some of these moments of crises. The question is, if you survive them, are you back to where you were, or are you somewhere stronger? And in some cases, the most important in history, the moment when the government steps in and assists you in surviving, you go from a hypothetically strong position to a practically and historically proven strong position. So a lot of the faith is now kind of doubled down in that space, and so long as USDC remains able to access banking partners, which is a question that's still up in the air, there should be a lot more faith restored, and probably a lot more confidence in general that, yes, the government will step in to bail out the partners. And in fact, Circle has decided that even though it may be slower, having it clear that they can redeem through that investors and holders can redeem through Bank of New York Mellon, which is one of the largest banks in the United States, that will provide the safety and confidence in USDC. So moving forward, I would expect to see, short of a ban of participation in markets, and that would be followed by an orderly wind down or an unwind of the asset, not some chaotic zero peg control. Um, that USDC would gain significant traction. Over the weekend, we saw a version of a competing entity, Tether, take significant market share because while Tether does not have any clear ties to banks and is a total black box in many ways, and their reserves are not well audited, what they have done is limited the clarity of the exposure to risk of their deposits. So if you don't know where the deposits are, um, then it's kind of hard to say that there's a run on that bank. Um, and so Tether
It
could
is. It
be,
is the cockroach. The
yeah,
cockroach. I call it the cockroach of the crypto market. And as much uncertainty people have in it, it still finds a way to survive, and still holds a massive market share of the entire market. So and just going on your point, we also saw the decentralized options of DAI, LUSD, even things like Rise start to gain traction and their respective uh, governance tokens. So that'll be another initiative that we'll be looking at, another narrative that we'll be trying to focus in on and see how that plays out. But it is interesting to see that there is some competition in space, and in times of uncertainty, it just, yeah, like as you said, it was funny. People decided to go towards USDT, and um, it could be, going to the future. Is that the right play? And do we need alternatives? Absolutely, right. We need to see some transparency on chain. Um, I think that's what differentiates crypto. So, uh, yeah. Anything
yeah.
else you have to add there, Jordan?
No, those we will be a channel that does revisit some of the more boring topics. As somebody who was often shouted down as the crazy person in the room for the last year for having any price alerts set around USDT, USDC on my phone, suddenly, apparently, I'm not that crazy. And I think it's important we all understand the financial primitives or the underlying kind of core assumptions that are taken for granted in this market, and that includes understanding the mechanics behind things like DAI and LUSD and Circle and USDT. Um, Stephen's totally right. What we saw was a pretty big flight to what was available over the weekend, and treasuries weren't available over the weekend. They don't trade. Most fiat off ramps, in fact, all fiat off ramps were unavailable unless you had some Bitcoin ATM or something like that, and which is a tiny, tiny, tiny number of places. And so and in fact, there are photos of some of those running out of money. In that moment, the options were USDT, Bitcoin, Ethereum. So people went for the majors. And my thesis was they would hold through the weekend. And then when we got a rescue plan, it was not people being fearful that they couldn't off ramp. It was, well, if rates are going to come down now, why not speculate? And so, yeah, that's kind of the wrap up of this. And we'll be revisiting more boring and kind of longer dated topics throughout this, and also getting on some spicier topics like how Caesar and I disagree on GameFi, or how some degen protocols emerging. That's interesting, but probably not going to work out in my opinion. And we'll have some interesting debates there. So thank you for joining us. I'm Jordan. This is Stephen, and this is Reflexivity in Markets.
Yeah. Don't forget, guys. If you like this content, make sure you do share it with someone that you think would benefit. Um, like and start subscribing to us. We'll try to bring on some content regularly. Um, yeah, we hope you guys have a great week.